It's a real pleasure to have with us Dave Sather, the president of Sather Financial Group based in Texas. Dave, welcome.
Thank you. It's great to be here.
I'd love to learn a bit about your background and how you got started in investing.
Okay. When I first got out of graduate school, I was working in Houston, and I asked a young lady to marry me, and she didn't want to move to Houston. So I had to find some work in the town she lived in, and I happened to find a job working as a stockbroker for Payne Weber. And it was a good job. I got my foot in the door, and it taught me two things. I loved the investment business, and I hated selling on commission. And so, I did that long enough to at least make that realization, and from there I started realizing some of the conflicts of interest that are present on Wall Street and when you work for some of those big firms, and I started looking more for a path that would allow me to pursue independence and really to represent my client's best interest.
And when did you start the firm?
My firm I started in 1999, so just celebrated 13 years.
Great. Well, I'd love to hear more about the approach. So what types of clients do you attract, and how do you go about servicing them?
About the time that I was thinking about it, it was the mid-1990s. You threw money into the market, and it just went up by 30%, and everybody was a genius. And anybody who's studied history knows that markets don't always go up. And I started looking at our clientele and realizing that for us, we really needed to be providing broader services. At the time, I had transitioned over. I was running bank's trust department money, and all we would do is offer them investments. We didn't do any other wealth management services. And so I sat down with my boss one day, and I said, one of these days this great bull market's going to end, and our clients are going to be down 100 grand, and we will have charged them 10 grand for that privilege. And I said, we really need to offer them some other services. And they didn't want to pursue that, but at the time I kind of figured, everybody has risk management needs, estate planning needs, retirement planning needs, kind of to complement the asset management business. And they didn't want to do that, and so that really was the impetus for me to go off and start my own. And it was also fee-based. The bank was wanting me to work on commission again, and I just saw that as being a big conflict of interest. So that was 1999. At the time, I just thought, if I could just manage a little bit of money, we'll be okay. And so today we manage about $300 million, and it's for what I would consider to be pretty under-the-radar screen type people. If you've ever read the book, The Millionaire Next Door, our clients are more apt to show up in a pickup truck wearing boots and blue jeans. They are generally oil-field services, they are in the energy patch of some way, or they do construction. Very rarely are they high-profile people. They're just very hardworking. One of them owns a salvage yard, another one has mobile home lots. I mean, it's really just amazing the number of ways you can make a living in a capitalist society. And for some reason, where we live in South Texas, there's just a lot of people who are able to make a very good living that way. And so that's very much the way we do it. We don't advertise at all. It's all been word of mouth. It's really been a lot of fun.
And you're also a professor at Texas Lutheran.
Yes.
And passionate about value investing and teaching it to students. I'd love to hear about your approach and how you, value investing is a big tent, and there are various ways to go about it. What is your philosophy?
Well, when I first got out of graduate school and I was working for Payne Weber, I was very thankful that I got to go to graduate school and get my MBA, but I wish somebody had knocked me on the head and said, hey, if you're going to go spend all that money, you need to figure out who Warren Buffett is and figure out why he's successful and what he does. And so very early in my career, I started reading, this guy was so successful way back then, and it was obvious that something about the way he did things worked very, very well. And so fortunately there were, I could always get his annual reports. Back then I used to call his office and I could talk to his secretary directly and ask her to mail me an annual report, and she would. I didn't have enough money to buy A shares. Those were the only shares that existed back then. But, it was obvious that he just had such a common sense approach about investing, and it really made a lot of sense for our clients. So Texas Lutheran is where I went for undergraduate. And it's a very small school. It's only a little more than 1,000 students, but it's really got a great business program. And I serve on one of their advisory boards for the business program. And one day we were talking about internships. And I started thinking about the nature of money management and the critical thinking process that goes into it, and realized that this might be the type of platform that you could actually build and gain momentum. And so I pitched the idea to them, and my first summer I had 3 kids that just sat there and read nothing but Warren Buffett books all summer, kind of outlining them, and The Intelligent Investor and The Warren Buffett Way, Buffettology, interpretation of financial statements, all those types of things. And then in the fall we got 5 students, and then 5 grew to 8, and 8 grew to 15, and so now it's going into its 4th year, and it's really gained a lot of momentum. The trick, though, for me is recognizing that a school this small, very few of our students are going to become portfolio managers. Instead, our approach has been far more to say, okay, how does Warren Buffett look at a company? He's very famous for saying, it's got to be consistent, predictable, and I've got to be able to understand it. But really, if you read a lot of his stuff, he has great discussions about return on equity, return on capital, debt issues, debt divided by net income. Just great fundamental analysis. And so the approach of our intern program was to use those characteristics to teach kids what is the difference between an average company and a really great company. Because if they understand that, no matter what company they go to and whatever industry they work in, they'll be able to go back and say, I know that our debt is X, and the kind of company Warren Buffett looks for is far different. Why? And that, to me, gives them a real competitive advantage when it comes to competing against other universities and students from all around the world.
Well, that sounds great, and I'm curious to hear about how do you go about taking that philosophy and implementing it for your clients in the business?
It very much is a direct correlation. We've been at this a long time, and my staff, really, they're partners. They make me look far better than I really am. But we sit down just in a group format and discuss ideas, and some of the research was provided by our interns at Texas Lutheran, and a lot of it we did ourselves. But it's to come up with companies like, Tesco, which is one of Warren Buffett's, holdings right now, to sit there and look at why is it down? Why would Warren Buffett like a company like that? To figure out, okay, here's a company trading for 8 times earnings, but it's got better than a 5% dividend yield. And yet, when you look at it, it's trading for well less than tangible book value, and probably trading for less than just the value of its real estate. So you're almost getting the business, the operating business, for free. That's the kind of thing that when we sit down, that light goes off in your head, and you just say, "This is real. This makes sense. I can understand Tesco. We understand Walmart in the States. The Tesco model is very similar, and in some ways, I think it's actually better." And so, when you look at our portfolios, you see a lot of names like Johnson & Johnson or Budweiser, Philip Morris, things like that that are, in our opinion, very simple to understand, but the fundamentals are very good. And this was a good old Texas kind of a saying. When I first got in the investment business, there was this old man, he was 80 years old, he was still working. And he knew I was going to go up to New York for training, and he goes, "Oh, you get some of that fancy book learning." And I said, "Yes, sir." And he goes, "Look, I'm going to tell you everything you need to know in one sentence." And I thought he was just kind of pulling my leg. And he goes, "Eat 'em, drink 'em, smoke 'em, go to the doctor, and look good when you get there." And I just stopped, and I chuckled, and I said, "Come again?" And he said, "All right, follow me, Sonny." He goes, "Eat 'em, your food companies. Drink 'em, your beverage companies. Soda water, milk, juice, hard alcohol. Eat 'em, drink 'em, smoke 'em, cigarette, tobacco companies. Go to the doctor, your healthcare companies, and look good when you get there." And he goes, "Your wife will allow the house to be repossessed before she will go out into public without her hair being done. And it was funny, you know, so that was the early 1990s. 20 years later now, that philosophy allows you to take advantage of markets, but also not to blow clients up. And so in 2008 and 2009, really tough times. A lot of our clients were very panicky. Again, we don't manage a portfolio, one portfolio. We manage portfolios for individual clients. A lot of people very nervous. But because of the fundamental research we did, we knew that Walmart was not going to go out of business. They might be strained, but when you looked at the actual money they were making more money each and every day. Budweiser was selling more beer worldwide every day. Philip Morris was selling more cigarettes every day. And as a result, it allowed us the opportunity to actually show our clients what was going on with the actual businesses. Turn off the news, turn off Wall Street, and say, if you owned 100% of this business, much like Buffett does, would you be satisfied with the results? And the answer is pretty much yes. And so, again, Johnson & Johnson, Colgate-Palmolive, Procter & Gamble's been in our portfolios in the past. It's a lot of very simple to understand type things. And then we'll do some other things to enhance the value of that, generate a little bit more income. Way back in probably the early 80s, Buffett wrote put contracts that generated a good size amount of income for him. And it allowed him to set a price on Coca-Cola that he was willing to say, I will enter into this contract. If Coke dips, I'll buy it at this price. And somebody else has to pay me for the privilege of selling it to me at that price. So the first contract Buffett wrote, it expired worthless, and he just got to keep the premium. The second one he wrote, it exercised, and he ended up with a ton of Coca-Cola, which he's very legendary for now. We implement that strategy on a regular basis. We're big fans of writing puts to generate additional cash flow into the portfolios. If we have done our homework, we should be able to sit there and identify what is a fair price or a price that we would be happy owning a given business. And if we're able to do that, and then we can enter into a put contract, there's been many, many times to where we've written put contracts just month after month after month, somewhere 7, 8, 9 months down the road. Finally, the market drops, it triggers, and we end up with a lot of option premium as well as a company we wanted to own in the first place. Now, obviously that involves some risk. To offset that risk, we always have the cash sitting off on the side. And so some of our clients always want to know why we have so much cash, but it's always because we know we have this outstanding obligation.
And have you, in terms of this particular strategy, have you found opportunities, the opportunity set kind of changing over the last year or two? How have these opportunities materialized or changed over the last couple of years?
Option trading is a very different business, to say the least. Most people approach it as if, like they're going to Las Vegas and an option contract is just something that they're going to trade into and out of. Whereas if we enter into an option contract, it's because we actually want to buy the underlying business. And so it's a little bit different, but the best time to write a put contract is when there's lots of pessimism on Wall Street. The market's down heavy and Walmart's never going to sell anything ever again. That's a great time for us to go in. And so as the markets come up over the last 2 years, the volatility has been less. So it's actually reduced our opportunities. But it's still enough to where you can generate some additional income. And that's been another key aspect of our portfolios, is with interest rates in the United States being at all-time lows. A lot of people are entering retirement, they need money to live off of, and they're not getting it. And so we can build a portfolio of very good blue chips that have portfolio dividend yields anywhere between 2.5 and maybe 5, but then we might be able to add another 2 or 3 percentage points to the overall portfolio's return by using option strategies.
And have you been using any other securities, or are you basically equity plus this option strategy?
We'll use others. We used to have a lot of foreign exposure. We got very, very lucky. Sometimes things happen. Early last July, we liquidated all of our foreign exposure, and our timing was just within 2 weeks. First time in 20 years we got that lucky, but I guess we were due to have one. But sure, we will invest wherever we find good opportunities. Coming out of the 2008 downturn, we owned a lot of domestic fixed income, US-based fixed income in the corporate market. A lot of corporate bonds were beaten down 30 and 40%, even though they were good on the terms, they were still making their interest payments, and it was very obvious to us that they would pay their principal back. We were able to make as much coming out of the 2008 downturn off of fixed income, almost as much as we were off the stock market. But in our perception, less risk because there was a defined end date.
Now, to step back a bit, how do you go about generating investment ideas? Do you use screens? What tools do you like to use?
Pretty much anything. We read Manual of Ideas. There's a plug for you. We try and read as much as we can. A lot of people will come to our office and they're shocked that the TV's not on and we're not, busy staring at the computer. We just spend a lot of time reading. And, if the more we get to read, the more ideas we find. You'll pick up little stuff through the Wall Street Journal or Barron's, but it's really not the type of things that we're interested in. We really want original ideas, and that probably comes mainly from that very small group of professionals that function in the value arena. It is truly a culture all to itself, and it functions very differently than the rest of the investment arena. So we read a lot. There's also a website, Guru Focus, Dr. Charlie Tian. We started working with Dr. Charlie when he very first got his website up and running, and he saved us a lot of time because otherwise we were downloading all the 13F filings and trying to compile them ourselves, and he was able to do that. And then, there's a bunch of value managers that have just done a fantastic job over the years. I love to read their reports, whether it be Howard Marks that we talked about previously or Southeastern Asset Management. There's Seth Klarman. There's a lot of very smart people out there, and I'm not so prideful that I have to come up with every idea myself. I love to read their stuff.
From some of the companies you mentioned, those are good businesses, and you're looking to get them at a discount if you can. But what about buying a business, perhaps a bad business, at a cheap price? Is that something that you also do, or what sort of companies or situations are you attracted to?
Yes, we will. If we think the value is there. And again, just getting back to the margin of safety issue. We owned AIG, American International Group, back in the early 2000s, and we were lucky to remove it from our portfolio when it got very complicated and we couldn't understand it. We own it now. It is a much simpler business. When you look at their main businesses, SunAmerica and Chartis, their insurance operations are actually very solid, very stable. They're going to be able to continue to grow. They're looking to expand worldwide. They announced today that they were going to continue to buy more shares back from the government. I think it's a very misunderstood asset because, again, your business partner is the U.S. government. You never expect them to make logical decisions. So the federal government owns 70% of the business, and you never know when they're just going to dump their shares on the market. Fortunately, AIG is producing enough free cash flow internally to where all the shares that the government has sold, they've been able to pony up and buy a significant portion of them. You've also got a hidden asset. So this is about a $58 billion market cap company. And if you just look at their PE ratio, it's in the 20s. It doesn't make sense. But if you actually look at the free cash flow, it's very deceptive. The free cash flow yield, as far as we see, is probably north of 20%. And it's because there's a hidden asset that's buried deep within the footnotes that to a taxable investor is very meaningful. And that is that they've got about $23 billion worth of tax loss carry forwards, and then they've got another $4 or $5 billion worth of tax credits from foreign taxes paid. So, if you're in the 35% tax bracket, you're looking at somewhere around $12 billion worth of assets that aren't even reflected anywhere on the balance sheet. It's just a footnote. In our opinion, as the business continues to roll forward, every day they make a little bit more progress, they're not going to pay any taxes for a very long period of time. The free cash flow from that business is going to be very handsome, which will allow them to either make strategic acquisitions, increase the dividend, or buy back shares. So that's one that, in our opinion, is very misunderstood. It's kind of exciting. A lot of our clients really don't understand why we would put it in their portfolio, but that's a perfect example of something that we think is mispriced, mainly because it's misunderstood.
What do you think is then the main risk to your investment case with AIG?
I guess the government could always do something dumb, but I think it's more likely that the government is going to want to just get their money back. Bob Ben Moshe, the CEO, he has said, not only do we plan on paying the government back everything, we actually think they're going to make a very handsome profit off of it. So if AIG is profitable with the CEO that they have faith in, I see them as being willing business partners, maybe not happy business partners, but willing. And so I think the government actually can be an ally if we have another really bad 2008 type event. Actually, I think the government will be a backstop, whether they want to be. I mean, they're not going to unload 70% of the market share in the next year or two anyway. And the other thing too is that insurance is a tough market. Sometimes you have soft markets and sometimes you have hard markets. And sometimes people bid stuff at ridiculously stupid prices. And it can cause the profitability of insurance to be depressed for considerable periods of time.
And have you found some other companies in the financial space that attract you, given the carnage there? Or a lot of value investors are not very comfortable when it comes to financials. What's your view?
I think for the right one, there's opportunities. If you really want to be more speculative, the warrants on Bank of America, Wells Fargo, and Citigroup are very interesting in our opinion. Wells Fargo is probably the easiest one. We know that that's always been a Buffett favorite. The free cash flow out of Wells Fargo is outstanding. Going forward, just because of the net interest margin pressures that we think are going to be present, they probably won't earn quite as much going forward. But I do think they're going to continue to be able to work their book of business. They have a lot of money they can lend out under the right circumstances. So either the common or the warrant, I think, would be very good opportunities. We own a fair amount of both. The other one that we've done well with is Bank of New York Mellon. Yeah, again, misunderstood. Everybody hears the word bank and they immediately just sell it. But it's not a bank. All they are is a processor. Their banking operations are actually very minor relative to their custody business. So all they really are, in our opinion, is a great big bookkeeper. They're just keeping track of who owns what and charging a very slim profit margin, but the volumes are phenomenal. So, just back in November or December, we were able to buy that at 70% of tangible book value. It doesn't have any of the nastiness associated with a lot of the banks that were associated with the mortgage downturn. A lot of upside in an asset like that. I think it's very easy to get a 50% return on your money over a short period of time, 2 or 3 years.
Has BNY Mellon been impacted at all by what's happened with MF Global in terms of, are there any counterparty risks there?
I think that remains to be seen. None that I'm aware of that are material today, but when it comes to litigation, we're still dealing with litigation risks from 10 years ago for some of our clients. And so never say never. Tomorrow may unearth something that we didn't know about, so it's possible.
And you're also director of a business bank of Texas.
Yes.
I'm curious, is that also a perspective into the financials that gives you? Can you give us a sense of perhaps more broadly speaking the industry when it comes to, for example, the commercial, some of the regional banks? Is that interesting?
To me it is. I had worked at a bank, and to me the banking business is intriguing. I think banks can be run to be very profitable. This was an opportunity to participate with some people that I really respected. It was the first time that we had seen a private placement to where the CEO, instead of asking for stock options, he wrote the largest check to actually put equity into it. And he was a 30-year banking veteran, and in order to run this entire operation, he was asking for a salary of about $80,000 a year. His ego was so modest. I had never seen anything like that. And there were some significant tax advantages to the way we structured the bank. It's an S corporation, which has pass-through advantages for the earnings and the expenses to the individual shareholders. So I think the idea was a very good one. Our timing couldn't have been worse. We started the bank in 2007. However, I've really got to hand it to the crew that runs it. It is the #1 performing bank in the country out of all banks that were started in 2007 on a return on equity basis. We have had 0 bad loans and no classified assets because of very stringent requirements. And that made us look very conservative when the mortgage market was still booming in 2008, and finally started to show some cracks, and people started saying, oh, maybe these guys know what they're talking about in 2009. So we've been able to continue to grow, but it's a very conservative trajectory. It is a profitable bank, but we only focus on businesses. So mortgages, that was never a business that we wanted to be in. And again, the CEO who came up with the idea, he said after being in the banking business 30 years, that it's kind of the old 80-20 rule. 80% of your profits come from 20% of your clients, and those 20% are generally business clients. So let's just focus on the business clients, which made a lot of sense. So out of that, the economy in Texas is a lot stronger than it probably is anywhere else. We still see demand for loans. There's lots of demand for bad loans. There's lots of demand still for real estate loans. And I think sometimes because we're a smaller bank, a lot of times they think they can maybe pull the wool over our eyes. But we have continued to grow. We have lending operations all over the state now. We're a nationally chartered bank, so we can lend really pretty much anywhere nationwide. But it does give us pretty good opportunity to see how Wells Fargo is as a competitor. They're very strong. Bank of America has an awful lot to work through. I don't think Bank of America is nearly as much thinking about their future as they are just trying to fix what they've got. Whereas Wells Fargo is very much trying to think about the future. How do we cross-sell our clients? How do we provide our clients with more service and more products? So when I look at the competitors that Business Bank of Texas has, Wells Fargo is a very good one, but one that we're able to take a little business from too.
And when it comes to the beaten down regional banks, I guess some investors are playing it in the private market with government support. Yes. Others may be doing it in the public markets. Do you see any opportunities in the public markets?
We've actually looked at that. This is not something that our bank could do itself. You could either buy toxic assets as individuals, or possibly we could take over another bank's assets. Again, being business partners with the government is difficult, and we have now found the right opportunity to where we could cherry pick the assets that we felt offered good risk-reward value. I think it's a very interesting one, and I think you're right that certain people that probably have more money than me and better political connections have probably been able to navigate a little differently. But then as those competitors leave the marketplace, there's one bank in Houston that ended up having severe financial troubles. There were just certain small business loans that they couldn't make or just chose not to make. So even though we weren't able to take their loans away from them, when new loan demand did come up, it came our way. So I think you're seeing some attrition as some of these troubled banks have to deal with their balance sheet. They have to raise their Tier 1 capital. They have to function under more conservative situation balance sheet-wise, certainly. And so to me, it's giving us good opportunities, but I think it is going to be a long time before anybody sees the end of the banking problems.
And presumably through being in that space, you also get some interesting insights into the housing market. And can you tell us a bit about whether you see any opportunities in U.S. housing, or what's your view on that?
Sure.
Industry?
You know, if if I had the capacity and if I had the right team to do it, I think in the right markets, there's probably great opportunities to go buy single-family residential homes. My history or my experience has shown that things like apartment complexes are far harder to monetize if you need to. There's a very specific buyer for an apartment complex, whereas if you have 20 homes, you can sell one of them, and there's generally a demand for single-family starter homes almost always. And a lot of what we have seen is that as the mortgage market really expanded and lent money to people who should never have had the money lent to them, they went from owning a 1,600 square foot home to a 4,000 square foot home. Now they can't sell it, they can't take care of it, they can't pay the property tax, the insurance, etc. So that person either is going to go back to an apartment or trade down to a starter home. To me, the easier money is probably in the starter homes. And I think in the right market, there's probably a good opportunity. I don't think Texas is one of those, though. Texas never had the runaway home equity lending that other parts of the country did. Our lending schemes were very conservative, and so we never had the big real estate boom, but we never had the real estate bust either. So I think if I were to look that way, I'd probably be looking at maybe California or Las Vegas or Phoenix or Florida.
And is a big part to that investment case the financing element with the 30-year fixed at around 3% or less than 4%? Is that really what makes it compelling?
That, and I think if you buy it right, you can get it way below replacement cost, certainly on a single family home. You know, if you think about the tax deductibility of mortgage interest, you know, let's say that you're able to get a 4.25% mortgage, really your net cost of funds is somewhere in the low 3% range. That's very attractive if you're able to do it for the next 30 years. And, you know, even though our government likes to tell us there's no inflation, I think there is more. And one of these days, I think we're going to have to face the fact that there is inflation. There will be pressure on interest rates. I don't think the U.S. is going to get away with dictating interest rate policy to the world. One of these days, it may be 5 years from now, maybe 10 years from now, but any mortgage at 4% is going to look like very easy money. And so, yes, I think it makes home affordability very attractive just in terms of how much money you've got to put down, and allows a smart buyer to build some pretty good equity. And if you're renting it, the cash flows are probably pretty good, well offset your expenses there.
And in terms of the public markets, any opportunities in housing-related stocks, is that something you've looked at?
A little bit. You know, we own a little bit of USG. So many of our clients are in the construction business and have done pretty well. It's interesting for us to watch some of those. But probably our biggest exposure to the housing market directly is Berkshire Hathaway. Yeah, if you look at it, I mean, there's at least 7, 8, maybe 9 different divisions that are housing related directly within Berkshire. So you're getting an awful lot of exposure there.
Do you think that's one of the reasons why Berkshire is also mispriced? Is that people see this exposure and just are not able to think long term?
Yeah. Americans are notorious for thinking short term. Wall Street is notorious for thinking short term. So sure, that's certainly in there. You know, I think Berkshire is a very complicated asset. There's Buffett's age, there's his cancer scare. You are dealing with such a large capital base at this point that to continue to compound your book value at 20%, you know, Buffett has said for years, the law of large numbers will catch up with us, and we will not compound at this rate. And I think he's starting to face some of that. And so I think taking that money and reinvesting into Burlington Northern, for instance, I think Burlington Northern is a much more efficient business today than it certainly was 10 or 15 years ago. But it's still a very heavy capital intensive business, and that's not typically the type of business that Buffett looks for. I think it's just that he can put a lot of money to work in a decent manner in that capacity. And so, you know, those types of things are present. Of course, owning utilities, you're going to get a rate of return, but it's not, Buffett cannot charge his clients 20% rate of return on utilities. That's tough. So I think there's a lot of issues with Berkshire, but I do think that it's still a phenomenally well-run business. In our opinion, whenever you can run an insurance operation and have a negative cost of float for as long as he has, you're basically getting free money. So if he does reinvest it into a business that's only generating a mere 10%, when you didn't have to pay anything for the money in the first place, it's a pretty good deal.
You mentioned Tesco. I'm curious how far abroad do you venture when it comes to opportunities? How perhaps in your portfolios, how important is non-US?
Again, Americans have a pretty myopic outlook, and sometimes we forget that something as simple as Coca-Cola actually derives 81% of its operating profit outside the US. So it may have a mailing address of USA, but it's just such a global multinational. And that's been a common theme through a lot of our portfolios. Very few of them are US only. They may be headquartered in the US, but in general, we actually look for companies that sell more than 50% of their product or derive more than 50% of their revenue outside the United States, just because it's a very big world. With the disruptions over in Europe, though, we've been able to find that a business like Tesco or possibly Vivendi, some of those businesses really have gotten caught up in things that are probably unfair to their individual circumstances. And so I think as value investors, we're starting to find value in other places. It's just a matter of how you go about researching it, especially with different international accounting standards as opposed to generally accepted accounting principles in the United States. So we'll look just about anywhere. Some of the easier decisions are here in the US, but just because it's not US domiciled certainly doesn't take it off the table.
I'm curious, have you looked actively into Europe as a result of the crisis to try to see what opportunities are there? Have you looked at Greece, Spain, Italy?
Sure.
How would you go about that?
Maybe I'll go on vacation to Greece. Maybe the trips are cheaper. Greece is so difficult because it's such a small economy. It's really hard for me to get a lot of traction and to be able to translate that into holdings in our portfolios. Spain, we own Telefonica, and that is a Spanish-based communication business. Again, probably greatly mispriced because everybody associates it only with Spain. It's got a massive Latin American, base, and they do a very good job. Has a lot of debt, and you're going to have a lot of volatility. Get a pretty good dividend out of it. I think it's going to be a rocky road, but it probably shows some promise under the right circumstances. It's just scary.
Perhaps if you could just talk about some of the mistakes and what things are you really trying to avoid when you think about making an investment? What are some of the, lessons learned over the 20 years being in business? What are you really trying to avoid?
One of the unique factors of us managing portfolios for individuals as opposed to a private partnership or a hedge fund is that our clients get to see their statements every single month. And there are some times to where we may feel it's appropriate to have half our money in cash or a cash equivalent. The clients are predisposed to where they tell us, we hire you to buy things, not to sit on cash. And so sometimes it's a battle of wills over, how do we stand up to the client and say, you hired us to do the right thing, let us do what we think is best. If the long-term results aren't there, then let's part company. Knowing who we want as our client, as opposed to trying to take all business that comes through the door, has been very important. And as a result, we've got a very low client turnover. So the average brokerage account or the average broker loses about 35% of their business every year. Our client turnover is somewhere around 3% a year. And some of those are people who die, and we haven't figured out how to fix that. So learning how to be very blunt with our clients and honest with them about what to expect I can tell you that after 2008, 2009, we've had to have some good reality checks with ourselves as to where is our circle of competence. And the debt issue has come back. And as a result, we've probably read more deeply about using kind of a belt and suspenders approach on, okay, times interest earned is fine, but debt to equity is fine, but you've got to come up with other metrics to figure out what can truly take this business out. And when you look at the great business failures in history, most of them all came from borrowing too much money. And then economic circumstances that were not anticipated change, and you can't pay the money back, or your lender is no longer your friend. So that's probably been the biggest one, is really trying to focus on the companies that we really understand, even if they're boring, even if our clients give us a hard time, and the ones that use the least amount of debt. And probably, to not necessarily just look at price to earnings ratio, earnings is one thing, but we all know that people report one thing for earnings because that's what they get taxed off of. Is really to dig down deeper and figure out what the free cash flow of a business is. If we owned the whole thing, what could we do with this business? And so I think probably having to turn my ego off has been hard. And it's difficult to be managing money for people you care about. And then you go through 2008, 2009, and you see them get hurt. And I don't think any of us did anything intentional to hurt them, but I still think that there's always more we could do to do a better job managing money. So I think going forward, hopefully we're a little bit more humble. We remember Warren Buffett's rule number 1, don't lose any money. Rule number 2, don't forget rule number 1. Just because we did in the early 90s, or in the late 90s and the early 2000s, we were able to identify that Enron was something we couldn't understand, and we avoided it. Same thing with WorldCom, the tech, telecom, and internet bubble, we were able to sidestep that. It was difficult at the time. It probably overstated our confidence. And when 2008, 2009 came along, we knew that the mortgage problems were there. We greatly underestimated how broad the impact would be. And so some of our financial companies, Wells Fargo, Bank of America, Citigroup, got hit a lot harder than we thought they could. And it's probably caused us to back away from some of those.
And to speak of bubbles, in your latest commentary, you talked about Apple, and I'm curious to perhaps if you could share your views on Apple or some of the other bubbles that you see out there.
I don't know if Apple's necessarily a bubble, but it's definitely a love affair. When we look at Apple, and give them all the credit in the world, Steve Jobs obviously was a fantastically bright man, very creative man, truly a visionary in terms of seeing probably not just 1 or 2, but 5 steps ahead of everybody else. But when we look at whether it be iPads or iPhones or things like that, 6 months after it's introduced, knockoffs are being sold at Walmart. That is not the definition of a sustained competitive advantage to us. And the technology world just moves so fast that you are constantly having to reinvest yourself. And I know Buffett has talked about Bill Gates being his good friend and saying how competitive Microsoft's world is, that they've got to reinvent themselves every 3 years. I think Apple's got to reinvent themselves every 6 months. That's a pretty hard trick to pull off. And then when you get to a $600 dollars a share type thing, such a phenomenal market cap, you start thinking about what it takes to cause that to go up by another 10% or 20% or 30%. I mean, not everybody in the world is going to be paying a premium to have the latest, greatest iPad. And so, sure enough, since we wrote that commentary, they've fallen from about $620 a share to, I think, $560 or $550 today. Certainly wasn't a market call, but it was just an observation that even with a great company, there's only far that a great company can go.
And in terms of other potential pitfalls that you see globally, I know macro is not a big part to your process, but perhaps some of the implicit risks in owning some of the global brands that also benefit from trends perhaps in China?
Sure. China's an interesting one. I mean, you've got a communist government. No matter how much they want to be capitalist, they're communist. I'll give them some credit for at least letting us sell product in there. So I think that's good. Where they scare me, though, is on their governmental policy. They definitely manipulate their currency. Of course, we manipulate our currency too. And I think right now we've got a lot of governments who are manipulating their currency, trying to stimulate demand by flooding the market with very cheap cash. Unfortunately, there's not a lot of velocity on that cash, and as a result, just lots of free cash or cheap cash is not doing us much, except possibly translating into inflation. I don't know when the inflation is going to show up. There's a great website called shadowstats.com. We enjoy reading their stuff. I think it's smart. They go back and they calculate inflation the way it was calculated with the 1990 metrics as well as the 1980 metrics. If you compare those side to side, the folks that run that site, they're showing you that inflation is probably somewhere between 6 and 10%, whereas our government is telling us it's 2%. It's a big difference. And I think it depends on how you calculate the numbers. I know for us doing financial planning as well as wealth management, we see our clients' food bills, our gas bills, insurance bills, everything they've got going up far more than what the government is telling them. And so, if you're a retiree or you're somebody who's just entering retirement, that's where the biggest risk is to us. You're 65 years old, and once you terminate your employment, you're no longer replenishing that cash flow. Now your investments or your pension has to satisfy everything. Pensions are being done away with, which means more reliance on self-funded retirement, like a 401k plan. If you're not positioning your portfolio to keep up with inflation, probably not in the first 5 years, but starting at about age 75, people start to realize, I don't have enough money. And yet their skill set is stale now and they cannot re-enter the workforce. So it's put great emphasis on their investment portfolios, far more so than we've ever seen, probably ever. 20 years ago when I got in the business, the models were that when you go into retirement, 60% in stocks, 40% in fixed income, and the fixed income produces 6% interest. Well, today they're lucky to get 1%. And as a result, we have a lot more people hiring our firm to produce portfolios that have blue chip stocks, that have dividends that continue to go up year in and year out. And they're consciously saying, yes, I understand that I'm going to have a lot more volatility than I historically wanted, but it's the only way I can make ends meet and keep food on my table.
And that is a big challenge, isn't it? And you see it every day, preserving purchasing power. How do you, so just if you could summarize, how do you approach that with your clients? It may not seem intuitive to them.
No, it doesn't. It scares a lot of them because, again, their whole life, especially some of them that are 70 and 80, you think about it, many of them were products of the Great Depression, and they were taught to be very risk averse and to stay away from the stock market. And here I am telling them, no, you better embrace it. And, obviously, we're not buying everything in the stock market. We're buying a very select group of securities that, Pepsi, for instance, it raised its dividend this last week. It wasn't a huge dividend increase, but it was enough to probably offset inflationary pressures. It was the 41st year in a row that Pepsi has raised their dividend. Everybody knows it as a soda company, but really, they sell Doritos and Fritos and Lay's potato chips. They sell a whole bunch of other things that really is the crown jewel of that business. That is a business to me that has very high turnover. It's very simple to understand. People all over the world will want to buy a Mountain Dew or a Pepsi or one of their products. And every year they're able to raise their prices a little bit, squeak some efficiencies out of the machine, and that translates into buying back stock, which increases per share earnings, and it also increases the dividend. And then they do increase the dividend every year. Those are the types of things that go into that, because again, we're not managing one pool of money and just saying, well, this is our pool. It's a little bit different for every one of our clients, but especially with the ones who are entering retirement, the cash flow generation is a huge theme.
And you see clients every day, and you've been meeting with individuals for many, many years. I'm curious, from your perspective, what is the single biggest mistake that investors generally tend to make?
Just as human beings, we are very emotional, and our emotions lead us astray. Our emotions lead us into love and out of love on a variety of levels, and investing is no different. The other thing too that I've noticed in 20 years of being in the business, when I first got in the business, I was the only guy in town that had quotes. Every client had to call me to say, hey, what did IBM close at today? Because the internet didn't exist. We didn't have CNBC, we didn't have Bloomberg, we didn't have 24/7 news. And now because of the proliferation of news, our clients are so much more tuned into what is happening at that very minute. And unfortunately, they are taking something that a supposed news reporter is telling them, and they're just running with it and making multiple levels of assertions as to what this very small data point might mean. And we always, we have to basically sit them down and say, okay, so Greece went bankrupt. Did Walmart sell stuff today? Did Coca-Cola sell soda water today? Did Philip Morris sell smokes today? And that's a very difficult thing to take a step back, think logically, and to assess this when off in the distance you see this burning house. And whether it be Greece or Spain, Portugal, whatever, there's always a burning house. And our job is to make sense of it and to make sure that our clients don't blow up. We don't put bad investments in there, but that they don't hurt themselves either. And that's actually the biggest challenge, is just trying to keep our clients from hurting themselves. And a lot of them are very good at it, but some of them that may not have worked with us as long, or maybe just their personality is a little bit more nervous, they're just jittery and they ask a lot of questions.
And what are perhaps some of the resources or books you tell them to read or to get perhaps more comfortable with that?
So some of them will read. I encourage them to read a lot of Warren Buffett stuff. If I find articles, one of the nice things about the internet is if I find a good article, I can immediately email it out. Some of them read them, some of them don't. We also write a lot of commentaries, and the worse the market gets, the more commentaries we write, just to try and put perspective on things, because it's an easy way for us to communicate with a lot of people quickly. And then I also write columns for the newspaper every other week, and so that is a variety of interesting topics, some of which are very investing related, and some are just general financial planning. But again, it's all about people and communicating well with people. The better you can sit down with them, help them to understand we're at point A today, we're trying to get to point B, and this is the most logical path to get there, generally that calms them down. And so, unfortunately, the downside of that is, in 2008, when we probably should have been reading more annual reports and doing more research, we spent the majority of our time just talking to clients. And so it's a double-edged sword.
You've been in business for 20 years, successfully grown your firm, and I'm wondering, what are your goals for the next 20 years?
Stay alive. No, I am an admitted workaholic. I work 7 days a week. I love my job. I don't know what I would do if I didn't go to work. I enjoy the teaching aspect, and I can see myself continuing to do that, but I don't ever see a time and a place to where I will just retire. To me, your brain is a muscle that needs to be used. Some of my favorite people were successful late into their 80s or 90s as business people. So there's a pretty high bar set for me to try and achieve as much as they have. I would hope that our firm continues to grow in a logical manner, in a profitable manner. If that means staying the same size, that's fine. If it means shrinking it, that's fine. As long as it's profitable and run for the right reasons. The other thing too is I'm 45. I think I'll live forever, but I might not. And so one of our big emphasis is to build the firm large enough and stable enough to where if I have a heart attack, if I decide to retire, if I want to take some time off, that our clients get the exact same level of service. And so there's now 5 of us in our firm, and I've been able to hire a couple of my former students, and they are starting to provide that depth. But that would be my goal certainly over the next 10 years. By the time I'm 55, I really think that my emphasis on the firm should be almost secondary. If I'm very good, I'm a financial planner by trade. I wouldn't be a very good financial planner if I didn't plan for my own transition.
Well, on that note, Dave, thank you so much for your time.
And thank you. I enjoyed it.